Okay. What did he say?
Well, please remain seated while we get started. If you have a telephone or other paging device, if you will cut it off so not to interrupt later today, we will appreciate that very much. It's a great day to be a Kiwanian. Kids need Kiwanis, and Kiwanis needs you, and we need you very much at this time. Our defining statement, let's start with that. Stand, please. I'm sorry. Kiwanis is a global organization of volunteers dedicated to improving the world, one child and one community at a time. Our Pledge of Allegiance. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. KC, I believe you have our song today.
My country is of thee.
I think we know. Country 'tis of thee, sweet land of liberty, of thee I sing. Land where my fathers died, land of the pilgrim's pride, from every mountainside, let freedom ring. Who has our invocation today? Do I have a volunteer? If not, come ahead, forward.
Let us pray. Lord God, we thank you for another meeting with our Kiwanis Club, and most of all, for everything we do for children and the community in general. In Christ's holy name we pray, amen.
Thank you, we appreciate that very much. Guest, and I did not, if you'll hand me the roster over there. But first of all, I'm going to start with letting you introduce your guest first. Jason is going to introduce a guest, which is important that we listen to this.
Well, as many of you know, we have started the process of choosing a new caterer, and we formed a committee, and it's going very well. And so we've had people who are caterers come in and meet us and see how we do things. So we have today Nicole Weil from Catering Works, which is based here in Raleigh. Nicole is originally from Lebanon, Indiana. And when she was young, she received an award from Kiwanis up there, so at a Pizza Hut. And she has been with Catering Works for about a year, but she has been in the food service industry since she was 16 years old. So she has good knowledge, and she is one of the people who will be serving us at an upcoming meeting. So we're happy to have her. Thank you.
Nicole, thank you for being with us. Let me tell you, this committee that I've appointed is really doing yeoman's work. They have identified 5 caterers, and what we're going to do is after the day, we're going to have one to come each week and then repeat. So for the next 10 weeks, we're going to have caterers, and we're going to have a suggestion box that you give us your ideas and what you think about that caterer. And the final decision will be made by the club, So I want you to take this very seriously, enjoy the food. Now, and I told them if they serve prime rib every week, and then the first week after we hire them, they serve chicken livers, I'm going to be upset with them. So and you understand it, and I appreciate that very much. Thank you so much. Nicole, we're glad to have you with us today. And let me say thank you to the Meadow Cafe. The Meadow Restaurant, which is down the interstate almost at 95 or just right past the 95 exit, has done a yeoman's job for us for the past year or so. And we appreciate it. Give them a round of applause. We're sorry to lose them, but as is happening so much in our time, they have a labor problem and a labor shortage, and they just don't have enough people to continue doing the labor. So we're going to be calling on others to be of help at that times. But thank you to the Meta Cafe. Let me also announce, and I did last week, that Charter Night has been canceled for the month of February. We're in the process of trying to merge it with Bill Burney Night, or at least make some other change there, but you'll be hearing about that. Our upcoming golf tournament is May the 2nd. Andy Wood is chairman of that. He'll be here next week to talk to you about it. It is at the Noose Golf Club again. At the Noose Golf Club on May the 2nd. We need sponsors and we need others to be involved in it. Be sure to bring your friends and put together a foursome. That would be great. The Carolinas District Mid-Year Meeting is scheduled for February the 10th, and we would like you to think seriously about going to that as a representative of this club. And last but not least, the Change the Future Fund, which is you put your change in that each week, it needs help. We've kind of got away from doing that, but we need to get back doing it. So if you got, doesn't matter what you got in your pocket, if it's loose change, just put it in there each week. We have a number of birthdays to point out. On the 17th, we have Harold Garner. On the 19th, Dick Hygert. I know you're here, Dick. Thank you. And happy birthday. The 19th, Jake Plotkin. On the 22nd, Fallon Hanley. And the 26th, Nick Fountain. And we'll be mentioning these again as we get closer to that particular date. And one more. Oh, I'm sorry, right there, a new member. Thank you so very much. Thank you so very much. Today is the day. Okay, well, happy birthday. We give you a big Kiwanis welcome. Does anybody have any membership welfare items? The only thing I have heard so far this week is that Charlie Sawyer's not here today because he has a real bad cold, and also Courtney's husband is back with the oncologist today, but he is doing okay otherwise. Are there any other announcements that we should make? Excuse me? Oh, sorry, exactly. I did the guest a while ago and forgot who else was on the board here. Excuse me. Lee Parker, please introduce your guest. I know you have more than one.
Thank you, Buck. Indeed, I will. Joining us today is a friend of mine. She has just moved down from Cape Cod and is now living at the Cardinal here in Raleigh. She's also the mother of our speaker. Please welcome Elaine Loyek.
Welcome. And another guest. You don't have one. Okay. Did you have another guest? I guess not. Okay. Well, in that case, let me turn it over to June Small, who will introduce our speaker today. And thank you so much for being with us.
I'm going to take just a minute here. Our speaker is Scott Loyek. I may or may not have said that correctly. Just hang with me. I think he'll forgive me if I messed it up. He's the Managing Director and Chief Investment Officer at Triangle Wealth Management. And I'm just going to add a few comments when I read his bio that I found very interesting, and you all might too. He has over 25 years of investment-related experience. As he states, he is a passionate advocate of the consultative approach of investment management, consultative approach, and he values the independent, client-focused culture at Triangle Wealth Management. He graduated from Wake Forest with a BA in economics with honors cum laude. He's also manager for the Kiwanis Foundation portfolio of about $1 million and doing a great job. And I've also heard on the street that he's a real aficionado of hockey as well as baseball. I'm not sure if that's true, but he's shaking his head as though it is. Today, he's going to share a 2024 financial market outlook, which should be of interest to everybody in the room. Will you welcome Scott?
Thanks, everyone. Glad to be here, and hopefully I'll be able to keep you awake during this little conversation. What we're going to do is take a quick look back at what happened last year, and then give some ideas at least about what we should be thinking about and what might happen next year. So I was going back and forth with June, and I was late getting her the title of this presentation, but what I came up with for this year is Janet and Jerome Save Christmas. And if you look over here, you'll see our Treasury Secretary and former Fed Chair Janet Yellen and our current Fed Chair Jerome Powell. And why I say they saved Christmas is if you look back to what was going on around Halloween, it was not necessarily a market that was going up. It was actually going down quite a fair amount. It was still up for the year, but it was definitely trending in the wrong direction. And that was happening for two reasons. One, the government deficit was growing, and that was sucking money out of the economy. The other thing that was happening is the Fed was still expected to be raising rates. Well, right around Halloween, both Janet Yellen and Jerome Powell got together and did, maybe not got together, but simultaneously did two things that sort of changed the course of the markets for last year. The first one was that the Fed said they were going to be done raising rates or close to done raising rates. So we called that a pause in the rate hike. So that took one of the major concerns for the market away, which was higher interest rates. The other thing that happened, and this one's a little bit more in the weeds, but the Treasury changed the way they were funding our deficit by issuing more short-term debt and less long-term debt. And what that did is it injected additional liquidity into the economy because it did not pull as much money out of the economy to fund the debt. It's not necessarily a long-term strategy, but it was something that was very helpful last year when we look back. So I've been giving these presentations like this for about 15 years now. This is probably the first time I want to start with fixed income. We always talk about equities when we're up here talking about the markets. But really for the last 2 years, and particularly last year, interest rates and fixed income have had a lot more to do with stock prices, bond prices, mortgage rates, house prices, everything than stocks. So I want to start with bonds this year. When we talk about bonds, we're talking often about this thing called the yield curve. And all the yield curve is the interest rate on bonds at different times throughout the year. And what you'll see for this year, which are those top two lines, are this year compared to last year. And you'll see that they haven't moved a lot. Rates stayed more or less the same. The only place you saw a meaningful move was on the very shortest rates, and that's where the Fed raised rates a few times this year. So as we come out of this year, we have a yield curve that's very flat. It's actually slightly inverted. And what that means is the interest rates on short-term bonds are higher than the interest rates on long-term bonds. And that's something we want to be mindful of. If we look back at how this evolved throughout the year, you'll see throughout most of this year, rates were actually going higher until that pivot that we talked about around Halloween, where the Fed funds and the Fed and the Treasury kind of worked together to start lowering rates and rate expectations. So that's something that we may or may not see rate cuts this year. We probably won't see as many as the market thinks. We might see 2 or 3, but just the act of not raising rates anymore is very positive for the stock market, because generally speaking, when interest rates are higher, asset prices are lower, whatever that asset is, whether it's your house, a stock, a bond, art, you name it. Last year was an interesting year also in the bond market from the sense of these charts we'll show one for stocks in just a minute too. But what this shows is how the asset class did at the end of the year. That's the darker of the two bars. And then the little red number with the dot is where it went throughout the year. So while the bond market finished the year up 6%, at one point, not too far before Halloween, it was actually down about 7%. So that just shows the volatility that we've seen in the bond market the last couple of years. Last year was actually the worst year for bonds. 22 was the worst year for bonds in recent history. They were down double digits. That doesn't happen very often. We're happy to see them rebound this year and be up about 6%. And as we look forward, this chart sort of shows the risk return of bonds. So as we look forward, bonds look pretty good relative to where they've been in the past. And why that's true is because interest rates are higher. Bond prices go up when interest rates go down, and bond prices go down when interest rates go up. So we've lived through a period where interest rates have gone up a lot, and we're now getting reasonably good yields on bonds. If you've bought a bond or your investment advisor has bought you a bond, you might be getting 4, 5, 6% on that bond. So even if that bond goes down a little now because rates go up, that income that you get every year is still going to most likely give you a positive return. So that's one of the big changes we've noticed in the markets over the last several years, which is, hey, we can get a return on bonds now. And it's not a punitive return. It's a real number, and it's a real number that can help our financial plans, it can help our income, and it can help investors. So if you've been ignoring bonds for the last several years, you might want to talk to your advisor and revisit that, because they do look a lot different than they did 3 or 4 years ago. What's driving all of this from the Fed perspective, and we've all heard and seen and lived through a lot of this inflation, is this concept of inflation. And what we see here is inflation, how it has gone up very significantly, but then we've also seen how the Fed has brought it down fairly significantly. It's been relatively symmetrical. It went up pretty fast and it came down fairly fast, and hopefully that trend will continue. That's certainly what the markets and the Fed are hoping for. Why that matters is what we want to have in our economy is something called real interest rates. And what a real interest rate is the difference between the interest rate on a bond and the inflation rate. So if inflation is 4 and your interest rate is 3, your bond is giving you a negative real return after inflation. So the Fed and the markets and the economy much prefer a world where real returns are positive. So what that means is the bonds are yielding above inflation. And that's what we're trying to accomplish. That's what we're trying to get back to. As you can see in this graph, those 2 lines are converging. We've made a lot of progress. Still a little work to do, but we've made a lot of progress. Our inflation that we're seeing now is mainly in the service sector. And that means people. We heard about restaurants short-staffed. That's a very common dynamic across our economy. We still have these labor shortages. That's still one of the concerns around inflation. But some of the other factors like food and energy and even cost of housing have moderated somewhat, so we're not talking about those as much today when we look at inflation and worry about inflation. We've seen this not just in the US, but across the world. This is a chart showing the percent of global central banks in the G20, so the 20 larger economies, that are raising rates. As of today, it's down to just 12%. So that's much lower than it has been. In recent past, we've had a fairly coordinated global federal central bank raising campaign, so we're seeing that come down somewhat. And we're also seeing something that's probably more important, which is inflation expectations. And that's what's really going to drive longer-term bond rates. And that is, what do you think inflation will be 2, 3, 4 years from now, or 10 years from now? And those are still staying anchored around 3%. And that's a very positive thing for the bond market as well. The last thing, too much positive, I got to give you some bad news because we are talking about bonds and bond people are pessimistic. But CPI is inflation. And what we often see when we go through inflation is it comes in waves. It's not one and done. So you'll have this first wave of inflation. We'll get it under control to a certain degree, but there may be an echo or a rebound wave of inflation. So I don't want everyone to leave here thinking inflation's over, we don't have to worry about it anymore. Inflation is trending in the right direction, and if we do the right things, we'll likely have a chance to keep it low, but there is still a risk that inflation can return, and it has often historically. So now we'll turn to the equity side. And looking at the stock market, I'll start with this chart. It was obviously a very good year for the stock market. Certainly at the index level, the market was up about 24%. Much like the bond market, it also did get to a point where it was down 10% within that window. But certainly the strong fourth quarter helped propel the market meaningfully higher for the year. If we look at it from a where do we go over the course of the year, so here you can see the beginning of the year, we are basically exactly where we ended the year last year. So if you see, we started on January 2nd, we were at 797 on the S&P, and we entered the year at 770. So we covered a lot of ground, but we really are back to where we were sort of in that pre-Fed rate hike period. So what that means and what we want to look at about that is The market's gotten a little cheaper over that period. If you look to the left here, you can see the PE ratio in 22, when we started this rate hiking cycle, was about 21 times forward earnings. It's now 19.5. So earnings have caught up a little. PE multiples have come down. However, it's still not a very cheap market when you look at it on a historical basis. So here we're showing a graph that kind of looks at the market on an equity valuation basis. So if you're below the 30-year average, that middle line, you would argue, hey, the market's sort of cheap historically. If you're above it, you'd argue the market's kind of expensive. So we're not extremely expensive, but we're not ultra cheap either. So it's something we want to be mindful of. We want to make sure that we're taking prudent risks. We want to make sure that we're investing in quality companies, because the overall market itself may not provide a huge tailwind. It's probably going to be more individual stories of sectors and industries. One of the things that always drives earnings, and this is one of the things to be mindful of, is earnings drive stock prices. So when earnings go up, stock prices go up. So one of the trends we're seeing here in this little squiggly line chart is the far right, you'll see the 2024. These are the earnings estimates for the S&P 500 in 2024. And as you'll notice, they're going down. So that's something that the market will have to adjust to over time, because often you don't worry too much about the price to earnings multiple of the market as long as the earnings are growing at a good clip. But if people start to get worried about the rate of earnings growth, then that multiple becomes more of a factor. And that's something that may or may not become an issue this year, but it's certainly something you'd want to pay attention to going forward. Another thing within the stock market that's really unique and really different right now is how influential the 10 largest companies are. So we've heard about Apple and Microsoft and Facebook and all these things. They call them the Magnificent Seven now, but for simplicity's sake, we're going to call it the top 10. They make up 32% of the S&P 500. So there were points last year where these 7 stocks or 10 stocks made up over 100% of the market's return, meaning those stocks were up, the other 493 were down. So that's a pretty interesting dynamic as a risk manager for me to think about. Usually you always say don't have all your eggs in one basket, but to a certain degree, the market has a lot of their eggs in 7 baskets. So as we go forward, that's something to continue to watch. Certainly the impact of how those biggest stocks move is going to be important. One of the things we see here, this is just a fun anecdote. This is looking at the market cap, which is like how big these companies are valued, of Apple and Microsoft. And then we look at those two, and they're twice what the entire energy and material sectors are in the market. So Exxon, Chevron, Rio Tinto, copper, steel, all that. Add all those energy and hard stuff companies up, they're half of what Microsoft and Apple are alone. So that's a very weird environment to find ourselves in. It's something we certainly, don't see often. And I think it's something that certainly brings a new layer of risk. We are talking a lot about optimism around the Fed being done hiking rates. So yes, historically, if you look, these are sort of different scatter plots of different rate hiking cycles where the Fed has stopped hiking rates. And what's happened in these periods is generally that pause when the Fed stops hiking but before they start dropping rates is generally pretty positive for the market. So more often than not, the market goes up, which it did this time around too. So this is what happened in October, end of October. So we're seeing that same dynamic unfold perhaps this year. Historically, the downside is once the Fed actually starts easing or cutting rates, markets don't do quite as well. And that makes intuitive sense, because why does the Fed start cutting rates? Because the economy is struggling, right? So that's the concern, is how much damage will be done before the Fed starts hiking rates. Last thing on a forward-looking basis is we're looking at where we are and what historically returns have been starting from this point of valuation. So again, we talked about the PE on the market. Historically, when the PE has been around or above 20, which is where we are today, you have seen those market returns be a little below average. Not negative, just below average. And that just comes from you're starting at a higher level of expectations and a higher price. So now we're going to flip and turn to the economy and give you a little bit of an economic update. One of the things that is somewhat encouraging is we have sort of recovered from this GDP cliff that we went through in COVID. So the economy as a whole has returned to our sort of trend growth rate of around 2%. The other thing I'll point out on this slide is if you look at the economy, the biggest driver of the economy is the people in this room. It's consumption. It is what the consumers are buying and spending. So when we talk about the outlook and the mindset for the economy going forward, we need to start with the consumer. The consumers received a windfall during COVID, essentially. Savings ballooned. We saw about $2.1 trillion come into consumer balance sheets through that period. They have slowly been drawing that down. That's what this top left-hand graph there shows. And the savings rate has also returned to normal. Also on this bottom graph, you'll see revolving consumer credit, think credit cards. That's also back to pre-COVID levels. That doesn't mean it's bad. It's just not exceptionally good anymore. So the consumer is still behaving strongly. We had retail sales and some other numbers out this week. They all looked very good. But the consumer is back to sort of being in that average space. They may not have as much excess capacity to support the economy as they did a few years ago. Similarly, household debt service and delinquencies, again, not at alarming levels, but not at extreme lows anymore like they used to be. So just things to keep in mind. When we look at drivers of growth in the economy, and this one's a little more troubling in the short term, is the economy grows for two reasons. You have more workers, or those workers can make more. So we have a labor shortage, as we've talked about. The number of workers in our economy is not growing very quickly. And there's a number of reasons for that. It's a combination of the COVID issues and that slowing immigration, and then political issues around immigration. But our labor force is aging. Our labor force is not growing as fast. So it is going to be harder for us to continue to drive our economic growth absent significant increases in productivity. And that's where some of the more optimistic people are talking about artificial intelligence and some of those things being able to make people more efficient. But we have to just kind of see if that happens. So what's gone on in the labor market? The labor market had about 12 million extra jobs. It's now got about 8.5 million extra jobs. So the Fed has been successful in slowing that. They've also been successful in lowering the pace of wage growth, but it's still a very tight labor market. It's still very hard to hire people if you're trying. Quick word on real estate, because we hear a lot about real estate and people worried about commercial real estate and things like that in the economy. We have seen cap rates obviously come down, as they will when interest rates go up. The other thing we do see is a bifurcation, if you will, in the market between office real estate and everything else. So everything else is kind of within average. Obviously, office has yet to recover from COVID. So that's something that we'll continue to monitor and keep an eye on. The good news is, because everyone was able to refinance during COVID, this is not an imminent problem. It's something that will certainly work itself out over some degree of time. And if you're looking for potential places to have that show up in earnings or stock prices, you'll see that the majority of that commercial real estate here on the bar charts there are in the smaller non-top 25 banks versus your large systemic institutions like your JP Morgans as a percentage of their assets. So if you were worried, that might be an area to be more concerned about, is a potential to have another thing like Silicon Valley. Now, that was a truly unique situation that we went through back in March, but there could be other small ripples in smaller banks like that that have particularly concentrated or isolated real estate exposures that could be problematic. But we don't see that systematic financial risk that we worry about that hit from 08 and 09 that could lead to a real substantial long-term downturn. All right, I hate this part because I hate politics, but it is an election year and I have to talk about it. The US has never had a peacetime deficit this large. It's actually getting bigger because they're passing a tax cut as we speak. So there'll be another $300 billion on top of this. And that does not come without consequences. So this is what our budget looks like. That big white space on top is, basically the US credit card. The interest rate on that credit card is going up as we continue to raise interest rates and see rates go higher. So it is not necessarily something that we can ignore. It's also not something that's going to hit us overnight. It's just going to sort of be, the frog in the boiling water, right? It gets a little warmer. It's a little bit of an anchor. It's holding back the economy, but it's not going to be an acute event where it hits everything at once. However, it does impact the way the Fed can act. And I think this is one of the reasons why we may see some of those waves of inflation that we've seen in the past. When debt servicing costs are high, it's harder for the Fed to keep rates high for longer. The Fed is incentivized to lower rates because that makes it cheaper for the government to fund the debt. So what we see here is that when debt servicing costs are low, the Fed can wait a lot longer to cut rates. They can be more conservative. However, when those debt servicing costs are high, it costs the country more, so it's harder for them to be as patient. This is interesting given how well the consumer is doing and everything. People are doing better than they think they are. This is consumer confidence by political affiliation, but basically nobody's confident. Doesn't matter what political affiliation you are, nobody's confident. Yet they're still spending money and the economy is still growing. So I think it just goes to show that disconnect between politics and reality that sometimes incorporates ourselves in the world. Kind of bigger picture, long-term trend, we are moving back to a deglobalized environment. So, we went through this era of globalization starting in the late 90s with the creation of the euro and all these things. We're now moving away from that. So those forces of globalization were very deflationary. The forces of deglobalization will be more inflationary. So it's just a different mindset, a different thought. You can see here our trade with China in the bottom, how that's rolled over and is declining. There are obviously very good reasons for that. But again, it's just a change in the world. It's a change in the cost structure for businesses. It's something to be aware of in the background. Just a couple closing thoughts, because I know it's getting warm in here. We all want to get back to work. Last year was a really weird year. I got incredibly excited about CDs and treasury bills for clients. That doesn't happen often in our world. And the reason for that was these assets were so much better than what you could get in bank savings accounts or bank money market accounts that clients were able to earn 300, 400, 500 times the interest by buying a treasury bond versus a bank putting the money in the bank account. And that was a great strategy. You go buy a 12-month CD or a 12-month CD or a 12-month treasury, you bank that 5%, you come out way ahead of the 1% the bank was paying you. However, it is important to realize that while that was attractive, and it still is attractive to a degree, historically CDs and cash are not a long-term investment strategy. So what we're talking with our clients about this year is all of that money you have in cash, money that you really want to have in cash for the long term? Because if it's not, those cash returns are probably going to trend down if we're actually at the end of a Fed rate hike cycle, and we think the next moves will be to lower those rates. So we want to make sure that that cash is where it should be in your asset allocation. A lot of people do like to have cash, and it might be completely appropriate. However, other people may have put it there just because it was a good parking place and they were a little afraid or didn't want to step in front of things. But in the long run, you can see that cash historically will underperform other assets, and we wouldn't want people to miss those returns in the future. So the S&P has not had a negative return in an election year since 1944, re-election year, meaning an incumbent is running again. Equities might be underowned. So when you look at endowments and foundations and some of those large institutions, their ownership in equities is actually the lowest it's been historically as they have flocked to more alternatives and other things, private equity, what have you. So the stock market itself may be underowned. 87% of the time, which means 7 of the last 8 cycles of inflation, we have seen more than one wave of inflation. So that wave we've seen, there's been a second one 7 out of 8 times. This is a fun one. The countries representing 40% of global GDP and 80% of market cap will be having elections this year. So across the world, there are a lot of elections and a lot of political uncertainty going on out there. And last but not least, just reiterating that cash is not a long-term strategy. So are there any lawyers in the room? Here's the part you guys have been waiting for. Yep, that's the part you're waiting for. And other than that, if I am done. If anyone has any questions, I'm happy to answer them or answer them on the side, whatever is appropriate. Sir.
I hear that India is getting to be a huge global situation. In my mind, they've been kind of sleepy for a long time. Maybe not, but in the world news, they've been open. In the world news, they've been a little bit sleepy.
Yep.
But as I read about them now, I read something not too long ago that talked about that their population growth is not to where it needs to be, that their average age is something like 28.
Yep.
And, and can you tell me anything about that?
Yep, in many ways, India could be the new China in that they have a lot of people. They have a lot of people living at a lower quality of life, and they have a very young demographic. China has evolved to now have a very old demographic, which is why they're seeing some of the issues they're seeing today. The Chinese economy is actually not doing all that well. India has a lot of potential, and India has had a lot of potential for my entire career. And it's one of those places that has struggled to get out of its own way. They've had a lot of issues with shareholder rights, corruption, kind of managing businesses, sort of the governance side of things has not been great there. But the economic fundamentals, it's a relatively educated workforce. They have terrible infrastructure. That's one of the biggest problems. They have absolutely awful infrastructure. But there's a good educated population, and there's certainly potential there, and they could certainly be a beneficiary of people moving production away from China.
You just mentioned China, which was my question, but how do you see China's economy faltering affecting our economy?
They're linked to a certain degree. China has been, for most of my career, a deflationary force for the world because people could outsource production there, bring goods back cheaper. Over the last decade, China's wages have gone up, so it's not as cheap to produce in China as it used to be. There's obviously a ton of political risk in China. We see that all the time, as well as just sort of them copying and stealing products. There's also, the risk of them making it hard to do business there. They have about as bad a debt situation as we do in terms of their government debt and financial sector debt. So, they're interrelated. I mean, one of the reasons that the markets struggled to begin last year was that, everyone expected China to bounce back from COVID, and it never happened. So the degree to which they can kind of get things back on track would only help the global economy. But I think right now they're relatively weak versus their history or recent history from an economic perspective, and they're sort of trying to adjust to the new environment where people are doing the onshoring and changing distribution and trying to be more secure in their supply chains. And obviously some of the shipping issues that we have do not help China right now either, the Suez Canal and some of the other dynamics. Sir?
How do you see artificial intelligence affecting our economy over the next 5 years?
It's hard. I'm not a technology and science person, but a lot of smart people see a lot of potential there. It's a matter of how that's going to evolve. I think there's potential for a lot of efficiency, which by that I mean the ability to sort and analyze data. I don't envision that in the next 5 years we're going to get to a point where there's going to be a lot of decision-making comfort. So I don't think you're going to have autonomous driving. I don't think you're going to have, a AI basketball coach, for lack of a better word. But I think it's going to grow. I think it's going to improve. It's very expensive. I mean, these chips that NVIDIA sells cost millions of dollars. So it's not easy to build. Facebook was out this morning, they're mentioning they're going to spend $300 billion buying chips to build out their infrastructure. And then the other factor is there's a huge regulatory structure that isn't in place yet that's coming. And it's probably come in Europe first because it always does, but it's also going to come here. Sir?
For the last, seemed like 6 months, has been a push by 30 Republicans for the shutdown to government unless they reduce the debt. Thoughts?
Reducing the debt is good. Unless
shut down the government in order to get that?
Shut down the government just means the government can't do its job. So shutting down the government is kind of an indictment of all of the government because we've had divided government before and government shutdowns are relatively new. So I mean, my attitude on that is if your deficit is running at an unsustainable level, you have to cut it because otherwise it will be a problem at some point in the future. If you kept buying things and couldn't pay for them, At some point, someone would come knock on your door. And at some point, someone will come knock on our door. So it's not that we need to have a balanced budget. It's that we need to have some sense of control and discipline and some path toward a sustainable level. And that's what's lacking right now. And there's just no will to accomplish any of those things. I mean, the joke has always been, if you could put 3 people in a room, they'd figure it out, but nobody would pass it. And that's been done before with things like Simpson Bowls and.
Well, this is my important question. You Wake Forest guy,
Yeah, sir.
are you going to Omaha next year?
I went last year, I'm going back. I was out there last year and we've already made our hotel reservations for this year, regardless of whether they make it, but.
Can you explain Bitcoin to me?
No. Yes, I can. Are you familiar with the pet rock?
Yes.
Okay, so, or, Beanie Babies or Pokemon cards, you name it. So Bitcoin is something that doesn't actually exist in the world and is got an infrastructure to track who owns it, but it has no cash flows. It doesn't pay a dividend, doesn't pay interest. It has no net worth. It is worth what somebody will pay for it tomorrow. It doesn't have any industrial use, so it's not like gold or silver, because those you use for stuff. It is a speculative instrument that tends to track market liquidity. And by that, I mean when their Fed is cutting rates or quantitative easing is going on, it is still seen as an asset, and all asset prices go up in that environment, and Bitcoin is one of those. The good thing about Bitcoin is it just got a whole lot easier and a whole lot more transparent. About a week ago, they launched Bitcoin ETFs. So that is going to take a lot of the costs and friction out of the system for people who do want to own Bitcoin. And I think that's a positive thing, because it had been a very expensive asset to own, or a very kind of hard asset to keep track of. You hear about the guy with their Bitcoin on the thumb drive that loses the thumb drive and then loses all their Bitcoin. But it's like that stock that goes from 1 to 1,000. Is it going to keep going? I don't know. But there's no tangible asset there. It is simply which you could argue is the same for currencies too, but it's just a belief that it's worth something by a large enough number of people to make it so. Yeah, sure.
Taxes. I've got a question on your graph up there that showed the total amount of discretionary spending. It was about this big.
Yep.
The total amount of debt was about this big. And if you eliminated all the discretionary spending and maybe all the defense spending, you'd still have the deficit unless something was done to some of those entitlements or additional taxes were added.
I should invite Paul up for this. This is his pet issue, but.
Okay, so Paul, explain to us what's getting ready to happen here.
Well, no, I got, but, this has been a structural problem for a long time. Obviously, there are things that can be done on the cost side, but there also will be things that have to happen on the revenue side, right? I mean, we will need to decide, would you like your mom to keep having Medicare or Social Security? And if so, that's going to cost a certain amount of money, and that money is going to, come from somewhere. The best way we can solve this problem, and the least costly way we can solve the problem, is to grow the economy, because that raises tax revenue just by inertia. So that's why we always talk about, the supply side of economics, the tax cuts, all those things are about growing the economy. But that's not the only solution. Obviously, there's a ton of fraud in the system, Medicare, Medicaid fraud. There's a ton of waste in healthcare expenses. We see that every day when we look at bills and talk to clients. So there are things that the government can do to be more efficient. There are certainly things that the government can cut, but you're not going to cut your way out of this. It's going to be a multiple layers of different things. It's not a one-stop solution. But again, the object isn't to get it to zero. Like, we've historically not run a zero budget deficit. But if you run it at 2 or 3 instead of 7, 8, 10, it's sustainable. You can grow into it. It's okay. It's just that it's at such an extreme when things are good. I mean, this is about as good as things get. We have almost no unemployment. The economy's growing, and we still have a huge deficit. That's what's weird. if this were, the bottom of the cycle and we had this deficit, but it was going to get better as the economy recovered, that'd be a totally different picture too.
John, you're exactly right. It used to be, we did a presentation last year where they had the, sorry, can you hear me? We did a presentation last year on this, and Scott's right, it is my pet peeve. 85% of the money every year is already spent. If you look at Medicare, Medicaid, Social Security, all those items, interest on the debt, and if you throw in national defense, which I think you got to do, that's about 85%. And no one's talking about that. I mean, no one wants to talk about what to do with Social Security. We've got a whole presentation that you might want to have us come do sometime.
I think if you go on our website, there's actually a video of it you can find.
We have one more question.
Hi, Scott. A good presentation.
Thanks.
Excuse me. Any sectors you all like in particular in the market?
I mean, there are stocks in every sector, but
A few names would be okay. I got a pen.
My compliance person will not let me do that, sorry. I would say as a sector, energy looks cheap as a sector relative to the market. I think there's a lot of opportunity that we're seeing in healthcare. If you asked me this 3-4 months ago, we would have said financials, but that ship has kind of sailed a little bit. There are, as much as we bemoan these giant companies in technology, unlike the tech bubble, they're making the money. They've got the earnings. So I think it's irresponsible to own too much of them, but it's also equally irresponsible not to participate in them because they are leading and driving the economies. And when you think about investing in AI and some of the costs of doing those things, you need those balance sheets to do it. That's probably a starting point for places to look, but yeah, I mean, we like a lot of industrial companies because that's a really broad sector. So you can find lots of different companies in there. There obviously is an infrastructure program coming. So there are some companies that play into that. One of the trends that people were very excited, this is the opposite of your question, but one of the trends that people were very excited about a year or two ago was this vehicle electrification. And that's really stalling out. People who are going to adopt that and be the early adopters seem to have done that. And we're now sort of in this glut of the cycle where there isn't a lot of incremental demand. People are replacing them as they expire, but you're not necessarily seeing the same level of adoption. So Ford was out this morning saying they're going to cut their F-150 Lightning production because demand is not materialized for that product. And that was a major hope for the industry is as they move beyond cars into trucks and SUVs and even long-haul trucking, that there would be an incremental leg of growth. So I think a lot of the inputs to electric vehicles would be something I'd be a little more worried about if that was a big part of their thesis, the electrification. So give you both sides of the coin.
Do you know anything about the EV plant going to be built in Montour?
I do not.
Vietnam?
I do not. I'm sorry. No. I'll hang out if anyone has any other questions.
Thank you for being with us.
Happy to.
I'm going to give you or not give it to you, but I want you to sign that book as our speaker today. We'll give it to a library in honor, okay? Pen in there. Oh, there it is. Okay. Well, thank you so very much. Next week, we have John Davis, who's going to talk about what's happening in politics. So, and he's a good prognosticator. He has about an 89% success rate, he says. Well, I mean, that's the only person I've heard him that said that. Folks, thank you for being with us today, and have a safe weekend. Thank you, good night, and so long.